ready with us for the conversation. All right, let's go to him then. Dr. Ghosh, I was really looking forward to have this chat with you because you have a very differentiated view. When the GDP numbers actually came out, slew of downgrades for the economy actually came in. Most said that the reading is lower than estimated. Sure, it was. If you look at the consensus reading, but I was reading your note, which seemed to be highlighting a lot of positives which people may be overlooking in the economic reading right now. Talk to us. What are your thoughts on this reading which came, and going forward, how do you see the shape of economy?
Yeah, thank you, Ajay, for having me on the show. No, I think the GDP data which was released last week is definitely was below market expectations. In fact, we are also penciling in a GDP number of 15.7%. It came in at 13.5%. So from that point of view, I think we had actually downgraded our forecast to around to 6.8% for 7.5%. But beneath the numbers, that's why the report which we published said that as a statistical average, the data hides more thing than it reveals. So if I just go through the data, the first thing is that if you look into the sequential momentum, yes, there is a 9.6% drop in the sequential momentum of April to June over January to March. But if you actually do a seasonal adjustment over a seasonal adjusted momentum, you will find that the seasonal adjustment on a seasonally adjusted basis, the numbers are actually higher by more than 5%. And this is basically the highest acceleration if I take all the numbers from 2013 first quarter. The 2013 in the first quarter, always there is a seasonality involved. And this because the January to March number is also seasonal. So therefore, if we do a seasonal adjustment, the April to June seasonally adjusted GDP growth was significantly higher, and in fact the highest across all quarters beginning April to June 2013. That is point number one. Point number two is that the downgrades which have actually happened is actually purely a statistical artifact, because the important point, and this also you wrote in the note, is that the data expectations, all the data, the service sector growth rate was like hoping 17.6%, the agricultural growth rate was 4.5%. The only disappointment was the manufacturing sector, and I think the manufacturing sector disappointment had to do with a significantly distorted base. We actually pointed out that if we look into the profitability of the companies last quarter, that means in April to June 2021 or April to June 2020, the growth rate in profitability was as much as more than 10,000%. And this year, the profitability growth is around 11%. So if you do an adjustment over a number of 10,000%, no forecasting methodology will give you an correct manufacturing numbers. So manufacturing numbers will be grossly, it will be a purely statistical artifact, and that came out with the number. Also, the margins, if you look into the margins, which basically goes into the GVA calculation, that numbers actually also has significantly declined, and they are now at levels which are pre-COVID levels. So if we took these two factors into account, the manufacturing numbers was a result of statistical artifact, which I believe will go away as we move ahead progressively in this quarter, in this year. And finally, the important point, which is a data issue which we have raised this issue several times. We have been saying since for the last 3 years that the CPI data methodology is significantly biased. It is based on a 2012 consumer expenditure survey. Consumer basket has significantly changed from 2012 as Indian economy is witnessing structural changes. And the manufacturing output, the IIP, which is also derived from some of the IIP data, is actually based on a basket which is hopelessly outdated. You have items over there. For example, Nokia stopped manufacturing phones in 2014, but I believe Nokia is still a part of the IIP sample. The steel factories have actually shifted their productions to different places which are not part of a sample. And the most important thing is that handset exports, which is now which is touching everyday new highs, because new factories are coming in, Foxconn and others, that is not even a part of an IIP sample. So if you are working with a distorted IIP sample, I think that the manufacturing data will always be on the downside. And that is exactly which is happening, because after 2019, the pandemic, the exports of manufacturing growth and the IIP numbers are moving in different directions because of the fact that exports of handsets are not a part of the IIP, and these anomalies needs to be corrected immediately if you want to have a proper understanding of the GDP growth and numbers, specifically the manufacturing sector.
Right. Right. Excellent clarification, Dr. Ghosh. That's why I really enjoy chatting with you. What are your thoughts on another information coming in over the weekend, and that is India crossing the absolute size of GDP in terms of ranking, global ranking, pipping UK. Again, there is a view coming in that, yes, in absolute size, we may have crossed that size, but we are far away in per capita GDP. We are around $2,100, whereas UK is $47,000. What are your thoughts on this? And also, how is our rate of change happening in your observation for per capita income? Is it growing fast enough?
No, I think it's a very interesting point. In fact, on the weekend also, we published a note. We just pointed out one anomaly is that India actually had crossed Britain in December 2021 and not in June 2022 as was claimed. Because if you look into the quarterly numbers published by the IMF, you will find that India had crossed UK in December 2021 to become the 5th largest economy. India was the 10th largest economy in 2014. Has progressively break barriers. It has overtaken France, it has overtaken Italy, it has overtaken other Italy. In fact, Brazil and India is now stands at 5th. And India's share in overall GDP is now actually around 3.5% as against 2.6% in 2014. So in terms of, and India is likely to, and in the size of the Indian economy is likely to be this year in March 2023, which is taken at 2022 as IMF parlance, is going to be around 3.5 trillion. So yes, Indian economy is growing and the absolute pie is growing. But obviously, and in terms of the per capita income also, I think if you look into the progression of the per capita income, which is around rupees 1.5 lakh today for India, had dipped in the pandemic year. After that, it has witnessed a recovery. And the point which you mentioned that at per capita income, if you take into an absolute comparison based on these data, India is behind the UK's per capita income. But having said that, let me just also point out that there is another viewpoint which says that the size of the economy should be measured in terms of the purchasing power parity, because India's cost of living is also significantly lower than countries like UK. So therefore, the per capita income has to be adjusted by that cost of living. So if you do the adjustment, I think India, the picture changes a little bit. However, that does not take away from the point that India will need to grow. And as we grow up the value chain, and as we occupy the spaces which are being vacated by China, I think there could be an perceptible increase in the per capita income. Please note that countries like China had done it over a consistent period of 10 to 15 years, and there is no reason that why India cannot do it if it grows at a respectable rate for the next 10 to 15 years.
Okay. Dr. Ghosh, before I let you go, one quick view. As the data points stand right now, global as well as local data points, how do you see the next year GDP environment or growth environment in general, growth versus inflationary pressures environment?
See, I think ultimately there has to be a trade-off between growth and inflation. US, there is a viewpoint in that Europe could go into a recession, which looks most likely at this point of time. But US is actually could go into some sort of a stagflation because in US, the labor markets continue to be very strong. So that is one viewpoint. But for the Indian context, I think this year, there are varied perceptions about the growth rate. But as of now, I think even if we suppose hit a growth rate of 7%, I think that will be a very good achievement. But given the post-pandemic blues, my sense is that even if we are able to consistently grow at the rate of 6.5% for the next 5 to 6 years, I think that would be a satisfactory achievement. I think we should try to achieve whatever is achievable, because in the post-pandemic world where there has been a lot of structural changes, the economy has been moving up from, and India is trying to get the position of manufacturing, the value chain which China has vacated. So I think even if India is able to grow at the rate of 6.5% and maybe inflation keeps at 5%, so with a nominal GDP growth, even if we have a 11%, with a 6%, 6.5% GDP growth rate and 5% inflation rate, I think that would be some satisfactory achievement, at least for the time being. As of now, we should not try to push our growth rate significantly on the higher side, because I think that will take a little bit of time for growth to move up to the earlier ones, because no country today, if you look into the historical data for 60, 70, 80, 90s decades, no country today is poised to grow at rate which is in excess of 7% or so. So in that milieu, even if India achieves a growth rate of 6.5%, I think, of course, people can always say that we need to grow at higher levels. And yes, that's true. But I think that could be some sort of solace and satisfaction for our policymakers.
All right, Dr. Ghosh, we'll let you go on that one. Thanks so much.